people think retirement wealth is about chasing high returns late in life, but that belief alone quietly destroys more futures than any market crash ever has. The truth is far simpler and far less exciting. Before you retire, there are a small number of assets that matter deeply, not because they promise fast growth, but because they survive time, inflation, and human error. These are the assets that allow you to stop working without fear, to sleep without checking prices, and to live without becoming a burden to your own savings. The first asset you must own before retirement is productive ownership in real businesses. I do not mean trading pieces of paper or guessing which company will be popular next year. I mean owning small portions of businesses that sell necessary goods and services, generate real profits, and have proven they can survive recessions, wars, and changing technology. Over my lifetime, I have seen that a well-run business does not need brilliance to succeed. It needs discipline, demand, and time. A person who invested steadily in profitable companies earning even 8% annually over 40 years did not become wealthy through brilliance but through patience. $1 invested at 8% for 40 years becomes more than $21, while the same dollar sitting in cash quietly loses its purchasing power to inflation. People misunderstand this because they focus on yearly ups and downs instead of decades of compounding. The bad decision is trying to outsmart the market or jumping in and out based on fear. The good decision is boring ownership, held long enough for time to do the heavy lifting. The second asset you must own before retirement is income-producing real assets, particularly property that serves a basic human need. Shelter has never gone out of style in my lifetime, and it never will. A modest, well-located property that produces steady rental income does something remarkable for retirees. It converts inflation from an enemy into a quiet ally. When prices rise, rents tend to rise over time as well, while the mortgage, if you were wise enough to use one responsibly, stays fixed. Many people misunderstand property because they see it as speculation, something to flip or brag about. That mindset ruins them. Property is not about excitement, it is about stability. The bad decision is over-leveraging, chasing luxury, or assuming prices only go up. The good decision is owning something simple, affordable, and paid down by time and tenants. Over decades, this creates a stream of income that does not depend on your ability to work when your body no longer wants to. The third asset, often ignored because it feels invisible, is long-term fixed income designed for reliability, not return. Bonds, pensions, and annuity-like income streams are not glamorous, but they are the financial equivalent of strong bones in old age. When markets fall, these assets do not make headlines, but they continue to pay. I have lived through periods when stocks lost half their value, and I watched people panic not because their wealth declined on paper, but because their income disappeared. Retirement is not about how much your portfolio is worth on a good day, it is about whether it feeds you on a bad one. People misunderstand fixed income because they compare it to stocks in short time frames. The bad decision is chasing yield without understanding risk. The good decision is accepting modest returns in exchange for predictability. Compounding here is quieter, but it is real, and when paired with time, it creates a financial floor beneath your life. The fourth asset is cash reserves, properly understood and properly respected. Cash is not an investment, it is insurance against being forced to sell good assets at bad times. Over my lifetime, I have seen intelligent people ruined not because they were wrong long-term, but because they ran out of liquidity at the wrong moment. Inflation slowly erodes cash, yes, but running out of cash erodes dignity far faster. A retiree with 2 or 3 years of living expenses in safe, accessible form gains something priceless: patience. When markets fall, they do not panic. When opportunities appear, they are not desperate. Most people misunderstand cash because they either hoard too much out of fear or keep too little out of optimism. The bad decision is believing cash makes you poor. The good decision is using cash to protect your long-term assets and your peace of mind. The fifth and most misunderstood asset is not something you can buy on a screen, but it may be the most valuable of all: personal resilience through low fixed expenses and adaptable skills. I have seen wealthy people become poor faster than poor people become wealthy, and the reason is usually lifestyle rigidity. A retiree who needs a high income to survive is fragile, no matter how large the portfolio looks on paper. A retiree who can live well on modest income is powerful. Skills that allow part-time work, consulting, or teaching provide optional income and protect against the unknown. People misunderstand this because it does not show up as a line item on a balance sheet. The bad decision is building a life that only works if everything goes right. The good decision is designing flexibility into your finances and your identity. Time compounds this asset quietly as well, because experience increases your value long after youth fades. When you step back and look at these 5 assets together, a pattern emerges that most people miss. None of them rely on predictions. None of them promise excitement. All of them rely on time, discipline, and respect for human behavior. Inflation will continue long after you retire, quietly reducing the value of money that is not working. Compounding will continue as well, favoring those who started earlier and stayed consistent. The greatest enemy is not the market, it is impatience and misunderstanding. When people reach the later years of their working lives, they often feel an urgency that did not exist when they were younger. I have seen this many times. The thought that time is running out creates a dangerous impatience, and impatience is the most expensive emotion in finance. After watching markets and people for more than 90 years, I can say with confidence that retirement wealth is not built by bold moves at the end, but by quiet consistency over decades. The idea that one must make it big before retiring is one of the most damaging misunderstandings a person can carry into the final chapter of their financial life. Wealth grows in a very predictable way when time is respected. A person who saves and invests steadily for 40 years does not need brilliance or perfect timing. Even modest returns, repeated year after year, become powerful through compounding. If someone invested consistently and earned an average return of 7 or 8%, the money would double roughly every 9 or 10 years. That means what began as simple disciplined saving in early adulthood quietly multiplies several times by retirement. Compare that to the person who waits, delays, or stays in cash for too long and then suddenly tries to catch up in the final 10 years by taking large risks. That person is not investing. They are gambling against time, and time almost always wins. Most people misunderstand this because they focus on outcomes instead of processes. They see stories of rapid success and believe those stories can replace decades of discipline. What they do not see are the countless failures that followed the same risky path and ended in disappointment. Late-stage risk-taking feels logical because the mind says there is little to lose, but in truth, there is everything to lose. When retirement is near, there is no longer enough time to recover from major losses. A 50% decline at age 30 is an inconvenience. The same decline at age 65 can permanently change how a person lives for the rest of their life. Good financial decisions made early feel slow and unrewarding at first. Bad decisions made late feel exciting and hopeful, but hope is not a strategy. The calm, disciplined approach accepts that wealth is built through repetition, patience, and restraint. It understands that the market does not reward urgency, and it never compensates people for lost time. Inflation quietly punishes those who wait too long, while compounding quietly rewards those who started early and stayed consistent. Over a lifetime, I have learned that money does not respond to emotion or intention. It responds to time and behavior. Those who respect time by investing steadily, avoiding unnecessary risks, and letting compounding work retire with stability and peace. Those who try to compress 40 years of discipline into 10 years of urgency often retire with regret. The lesson is simple and unchanging. Retirement security is not created at the finish line. It is earned long before you can see it. Over the course of a long life, you begin to notice that the most reliable wealth is rarely created in dramatic moments. It is built quietly, almost invisibly, while people are busy chasing excitement elsewhere. Productive businesses have always been one of those quiet builders of wealth. I have watched empires rise and fall, but the companies that survived were not the ones promising miracles. They were the ones selling everyday necessities, managing costs carefully, and reinvesting profits year after year. Owning a piece of such businesses is one of the simplest and most misunderstood ways ordinary people create lasting financial security. Most people approach business ownership the wrong way. They treat it like a bet instead of a partnership. They look at price movements instead of profits, headlines instead of balance sheets. When prices move quickly, emotions take over and decisions become reactions rather than judgments. But a true owner does not wake up each morning wondering what the market thinks. A true owner asks whether the business is still serving customers, earning money, and reinvesting intelligently. When those things are happening, time becomes an ally, because profits compound in the background whether anyone is watching or not. Consider a business that earns a steady return and grows its profits modestly each year. If it earns $10 million one year and reinvests wisely, next year it earns a little more, and the year after that a little more still. That growth may look unimpressive in the short term, but over decades it becomes powerful. The investor who owns that business benefits not only from rising profits, but from the discipline of reinvestment. This is how compounding truly works, not through excitement, but through repetition. The market often ignores this because it is slow, and slowness is mistaken for weakness. Speculation, by contrast, feeds on speed and hope. It relies on predicting what someone else will pay tomorrow rather than what a business will earn over time. I have seen people confuse intelligence with activity, believing that frequent decisions lead to better outcomes. In reality, activity often increases mistakes. Each trade invites emotion, fear, and overconfidence. Ownership reduces those errors by aligning the investor with the long-term health of the business rather than short-term market opinions. The difference between good and bad decisions here is subtle, but decisive. The bad decision is buying something simply because its price is rising, without understanding how it makes money or whether it can survive difficult times. The good decision is owning businesses with durable demand, sensible management, and the ability to pass rising costs on to customers over time. Inflation does not destroy such businesses. It often strengthens them because their revenues grow with prices while their productive assets retain value. Over many decades, I have learned that productive businesses reward patience more consistently than brilliance. You do not need to be the smartest person in the room to benefit from them. You only need the discipline to hold on while others grow restless. Those who do this allow compounding to work uninterrupted, and uninterrupted compounding is one of the rare forces in finance that never grows old. When I think about the decades I have spent studying wealth and human behavior, I realize that one of the most overlooked lessons is the importance of reliable income in retirement. People often fixate on the total value of their portfolios, on headline numbers and market fluctuations, and they forget the simple truth that money is only useful if it delivers when you need it. Fixed income assets, pensions, and annuity-like streams have always been quietly underestimated, but they are among the most powerful tools a retiree can possess. I have seen fortunes appear and vanish, but consistent income has preserved dignity across generations. The value of an asset is not measured in how high it climbs, but in how well it sustains life through all seasons. Most people misunderstand income-producing assets because they compare them to stocks in short time frames. They see a stock rising 20% in a year and assume that higher returns must always be superior. Yet, when markets crash, those same stocks can fall 50% or more, leaving investors not only poorer on paper but often forced to sell to meet living expenses. In contrast, a fixed income stream continues to pay whether the market is up or down. If you hold bonds or structured income vehicles wisely, they do not promise spectacular growth, but they promise reliability. Retirement is not about impressive paper wealth. It is about stability, predictability, and the ability to meet daily needs without worry. Consider a retiree with a mix of reliable bonds and a pension that covers essential expenses. Even if the stock market falls for several years, this retiree can continue to live comfortably. The portfolio does not need constant monitoring or the emotional energy of chasing returns. This stability allows patience, reduces stress, and over time, preserves other investments that can continue to grow without pressure. Most people underestimate this because modern culture glorifies growth and excitement, but income streams quietly work in the background, protecting retirees from forced mistakes. The difference between good and bad decisions in this area is subtle but critical. The bad decision is relying solely on variable returns to fund retirement, assuming that high returns will compensate for timing errors or bad luck. The good decision is creating a foundation of predictable income that covers necessities, then using other assets for growth or optional spending. Fixed income may seem slow or unexciting, but over decades, it preserves the most important resource in retirement: freedom from fear, freedom from emergency sales, freedom from dependence on others. Inflation will erode purchasing power slowly, yes, but fixed income does not fail catastrophically the way speculative strategies often do. The retiree who understands this trades a small amount of glamour for the immense value of predictability. Over my lifetime, I have seen this principle save people more often than any clever stock tip or short-term market prediction. Reliable income assets allow a person to retire without panic, to make decisions calmly, and to let time continue working in their favor rather than against them. What I have learned after decades of watching markets and people is that retirement security is built not only on what you earn, but on what you can count on. Fixed, reliable income is not glamorous, but it is the quiet, steady force that allows all other assets to reach their potential. Those who respect this principle enjoy peace of mind and dignity long after the world has moved on to the next flashy opportunity. Over a lifetime of observing markets, businesses, and the choices people make, I have come to realize that cash is one of the most misunderstood, yet essential assets a person can hold before retirement. Many dismiss it because it does not grow, because it earns little, and because it is easily eroded by inflation. Yet I have seen more retirements derailed by lack of liquidity than by market crashes, by poor timing rather than poor judgment. Cash is not an investment meant to make you wealthy. It is a shield, a tool for preserving options, and a quiet form of financial power that cannot be overstated. People often fail to understand cash because it does not provide excitement. They compare it to stocks or real estate and conclude that holding cash is passive, even foolish. But the value of cash is not what it earns, it is in what it prevents. When opportunities arise, a retiree with cash can act without desperation. When markets fall, cash prevents panic sales of productive assets. When emergencies strike, cash allows choices rather than forced compromises. The retiree who understands this does not need to gamble to survive. They have already secured the one thing most important in later life: flexibility. Consider the mechanics of holding cash alongside other assets. Inflation will slowly erode purchasing power, yes, but a well-calculated cash reserve, enough to cover 2 to 3 years of living expenses, provides insurance against unpredictable events. If a sudden medical expense arises or a major repair is needed, having cash on hand avoids selling a business, a property, or a portfolio at the wrong time. This ability to avoid mistakes in moments of pressure compounds over years. Each decision that is not forced preserves the value of all other assets, and over decades, that preservation is as powerful as growth itself. Many people misunderstand cash because they assume that sitting on it makes them poor, when in truth having cash is a strategic form of strength. The bad decision is hoarding too little, leaving oneself exposed, or trying to chase higher returns on every dollar instead of ensuring liquidity. The good decision is maintaining enough cash to weather storms, even at the cost of slow growth, because without it, every other financial decision becomes risky. Time does not always favor the bold, often it favors the prepared. Cash also teaches discipline. It reminds a person of limits and allows one to act rationally instead of emotionally. When the market screams with fear or euphoria, cash keeps a retiree grounded. They can wait, observe, and choose actions with clarity rather than reacting out of desperation. Over decades, this patience multiplies. The benefits of other assets: because mistakes are avoided before they happen, cash does not compound in the traditional sense, but it preserves the compounding power of everything else. After nearly a century of witnessing wealth creation and destruction, I have learned that cash is not the flashy hero of a portfolio, but it is the silent guardian. It provides freedom, resilience, and patience. and in doing so, it allows all other financial decisions to unfold with the greatest chance of success. Those who respect cash before retirement sleep better, act wiser, and live longer with dignity than those who underestimate its quiet power. Over the course of many decades, I have observed that the most valuable asset a retiree can possess is often the one that does not appear on a balance sheet. It is the combination of low fixed expenses and personal adaptability, and it is quietly as powerful as any investment. I have seen people with ample portfolios struggle because they built a life that depended entirely on constant high income or inflexible routines. I have also seen modestly wealthy individuals live comfortably and confidently for decades simply because they understood how to manage their lifestyle and could adapt when circumstances changed. This lesson is rarely taught, yet it shapes the difference between freedom and anxiety in retirement. The essence of this asset is simple. Financial resilience comes from living within your means and maintaining flexibility. A retiree who can thrive on modest income is not at the mercy of markets, economic shocks, or unexpected expenses. Skills, experience, and adaptability create optional income streams that can be called upon if needed. This might mean consulting for a few months, tutoring, or finding part-time work that aligns with one's abilities. The value of these skills grows with time because experience enhances efficiency and credibility. Unlike speculative investments, which may rise or fall unpredictably, adaptability compounds quietly as a person ages, providing both security and confidence. Most people misunderstand this concept because they focus exclusively on asset accumulation. They assume that a large portfolio guarantees freedom, ignoring the reality that lifestyle rigidity can consume wealth faster than poor returns. A retiree accustomed to high fixed costs or dependent on a single source of income is fragile. A sudden market downturn, unexpected expense, or health issue can force decisions that undermine decades of careful planning. The bad decision is designing a life that functions only if everything goes perfectly, assuming that wealth alone solves all problems. The good decision is building flexibility into both finances and lifestyle, creating resilience that withstands the unexpected. Consider the practical effect of this asset. Two retirees may have similar portfolios, but one has low fixed expenses and adaptable skills while the other maintains a high-spending lifestyle and no practical way to supplement income. If the market falls or expenses rise unexpectedly, the first retiree can adjust without stress, drawing minimally on savings while continuing to meet needs. The second retiree may be forced to sell assets at inopportune times, eroding both wealth and peace of mind. Over decades, this flexibility preserves both capital and dignity, allowing retirement to remain secure and comfortable regardless of external circumstances. Time reinforces this asset because experience increases value in ways money alone cannot. The older one becomes, the more expertise accumulates, and the more options open up for generating income without significant effort. Those who maintain modest lifestyles have more control over when and how they spend money, and they are less likely to make emotional financial decisions. Inflation, market volatility, and unexpected events still exist, but the combination of low expenses and adaptable skills reduces vulnerability, turning potential threats into manageable challenges. After a lifetime of witnessing human behavior and financial patterns, I can say with certainty that low fixed expenses and adaptability are among the most enduring assets a person can cultivate. They do not generate headlines or excite gossip, but they preserve the ultimate goal of retirement: freedom to live without fear, to make choices without desperation, and to enjoy the fruits of decades of discipline and patience. Those who embrace this principle carry a quiet power into their later years, far beyond what even the most lucrative investments can provide.